September has been a challenging month for investors, with markets facing numerous headwinds, including economic uncertainty, sticky inflation, and soaring bond yields. Earlier, I spoke with Brad Simpson, Chief Wealth Strategist at TD Wealth, and asked him about his thoughts on the current state of the markets.
I mean, let's face it, there's been an awful lot of things that have gone wrong this year.
Yeah.
And yet, market has priced everything for perfection.
Exactly.
Right? Like that's the, I mean, if anything will catch you off guard, that's the one.
Yeah.
And so, usually when you're pricing something for perfection, rarely does, the kind of Murphy's Law, right? It's not always going to work out that way. So I think that for us, I think, especially I think maybe if you want to say perfection, that would apply really for the equity markets. But, even and I think if anything, a lot of the activity we've seen is on the fixed income side would be the area that's putting the strain on.
Yeah, and in terms of perfection, I mean, you're right. I mean, we've seen the economic data, we're still seeing strength where a lot of people weren't expecting it. But you could say the same for rates, and even you think about, the U.S. Debt was downgraded, and all these things you think would cause more tremors than they do in the equity side.
Yeah, no, on the equity side, and I think I think it's been pretty well documented that equity returns so far this year have been driven by, let's call it, the 7 to 8 stocks, and particularly we're talking if we're going through the perspective of the S&P 500, and when we're seeing the market, that's what.
Yeah.
But and so that's the good news. But when it comes to an equity investors, typically people don't own 7 stocks, right? And so if you take those names out, I think your average investor's experience is very different than what the headline is going to say, and I think that being cognizant of that so that starts to change the story a little bit for sure, right? And then I think if we take a look at the fixed income side, we have been anywhere this year between maximum overweight fixed income to overweight fixed income, which is where we are today.
Yeah.
And to date, that hasn't looked like a really great place to be. And so I think that for us, that certainly has been a big part of our year so far.
And so, and tell me about that call then. Are you still committed to that outlook?
Yeah, look, I think it's back to kind of what you've said, is that, if we look back at the beginning of this year and all the kind of the turmoil that we were going through, and you're dealing with working down inflation, and you're doing a war in Ukraine, and you're going through all these things, and then and you looked at that and say, well, boy, you're going to see all these interest rate hikes that we're going through. We get to the spring of this year, and let's say a 10-year U.S. Treasury was yielding about 3.8%, somewhere in there, and you'd think, well, it will probably start working its way down more, right? You raise interest rates to 5.25%, slow things down, and you see all the things that would be signs of it slowing. And here we are, September, and let's call it ish. A 10-year Treasury is yielding somewhere between 4.25% and 4.5%, which is not really where you would think you would be. So I think I call that this has been a speed bump, but we haven't hit a brick wall.
You've got a chart here I want to bring up, which is, if we bring it up, take a look. I think this is returns year to date and quarter to date. Tell me what you're paying attention to and what we're looking at right now.
Look, really what we do in my team is say, how do you build diversified investment portfolios for individuals with different levels of risk? And if in this term, if you look at what your returns are going to look like, if you're an aggressive or a growth investor, and you're primarily in equity markets, it's been a pretty good year.
Yeah.
If you look at clients who are more conservative, who are more inclined to be having more fixed income, you had a 2022 where we had one of the largest bond market corrections that we've had in history of markets.
Yeah.
And then you go, well, this is an event that is a real rare occurrence, which it was. Then you lead into a year like this one, and you go, well, we think that there's going to be a lot of rally here, and a lot of the return is going to make its way back again. What this is showing is that you're kind of in it for a conservative investor. You're up about 3% this year. You're about 3.5% for a balanced income. I think it's 4.5% for a balanced. I mean, that's a good start. But what we're showing on the quarter-to-date returns, kind of this April where all of a sudden interest rates started to back up again, you saw it stall. And then you even saw some of your returns were given back.
Yeah.
And I think that the important part is that we are still really comfortable with fixed income. And we were maximum overweight, we're overweight. And the only reason we went from maximum overweight to overweight was actually we think there'll be somewhat of a market correction, a stock market correction along the way.
Yeah.
We want to start raising some cash so we could be going in there. But the bottom line is that we think at a 10-year treasury the way it is today, we think that this bond bull market is still very much in place, and that we think it makes an awful lot of sense. And the key is it is much better to be early than it is to be late or not at all.
Yeah. Tell me what you're seeing then, if that thesis remains intact in terms of what your outlook is. The debate is hard or soft landing.
Right.
What do you see?
Well, I think that's when this really starts to get tricky, right? That first and foremost is that if we kind of rewound where we were 9 months ago, you would think, or that a lot of the commentary and discussion, and even from us, we're talking about is that you're going to start seeing the potential of interest rates. This is kind of going back January, February, of interest rates starting to go down and getting closer to an environment where you're going to have a recession. This is what you expect is going to happen. We started writing in the spring of this year that we don't think that's going to happen. That, we don't think there's going to be this recession. We don't think we're going to see interest rates back their way down. So that was the good news. So then the next part then you have to say to yourself is, you hear the soft landing all over the place, but what does that mean?
Yeah.
Right? You know what I mean? Right? A couple weeks ago, I just got back from a vacation where we went to Germany for 10 days. I would argue that Germany today is kind of in a soft landing.
Yeah.
Right? Well, guess what? That feels a lot like a recession.
Yeah.
Right? They're in a manufacturing recession. The services are slowing. You walk down the street, you see for rent signs on buildings, all the rest of it. And my point is that soft landing may not be what you think.
Yeah.
So what we want to do is define it. Like, what would you know that?
Sounds almost fun.
Right?
It's
yeah.
not.
No, that's right. It's not. So instead, what we said is a senior portfolio manager on my team, Fred Wong, came up and said, well, let's define it. What would we know it to be true?
Right.
And so we pulled out something that was called the beverage curve.
Right.
Right.
Let's bring it up, because I got another chart for us.
So the beverage curve is not what you think it is.
I had high hopes. It's not it.
It's not that. It's not nearly as fun as this. And basically, if you could go back to the mid-1950s, this is something that central banks have been using to analyze what is the health of the economy since then.
And just so we're clear, just so we're looking, because this is plotting unemployment rate against job vacancies.
That's right.
And there's a lot of red lines, and there's a plane, so and there's no time here.
It's a ton of fun. So if you look at the black little dotted line that goes through that, that's the average trajectory of an economy. The green lines are the movement of that economy and what does that look like.
Okay.
And in that is the relationship between your vacancies, right, and unemployment.
Okay, and that red line is then just the chaotic data that came out?
So what we're seeing here is that for 70 years, you could run along that line for vacancies and jobs, right? And that the peak there is the peak of COVID-19, that relationship departed in a way that we've never seen before, right? And so when you're saying, like, one of the things we're always talking about is, what are you watching? Yeah. Right. Well, we are watching employment, right? Like, that's the big. Like,
absolutely.
That's the big one, right? We're watching the consumer and employment, and you can see those two really go hand in hand with one another.
Yeah.
Kind of throw in your housing, and you get everything you kind of need to know, or what's the thing that's going to decide where you're going to go. So when that relationship is that broken or that apart.
There's a reversion.
Ultimately, it's going to revert back to that. So all we're showing here is that the strength of the labor market has continued to astound everybody.
Yeah.
Right? And what we're saying here is you can start to see that this is starting to work its way back.
I'm going to ask if we can bring it back up just to look, because you can see, like you said, your plane, I can see here flying around, but I guess July 2023, we're seeing, is that red line, that red
that's
dot?
where we are there. And so what we know is this plane will land.
Yeah.
And that when it lands, as you know, one of the things we're always saying is no one can predict the future. What we know is that we're going to define if we're a hard or a soft landing, the closer and closer we get to those green dots.
Yeah.
We get to that landing point. This has not been anywhere near that landing point. And so what's really is going to determine where we go from there. And so in the meantime, but what you do know, what's going to get you there is that if you look across the global economy, you can see to varying degrees, slow down, slow down, slow down. And so at different levels and different degrees, but that's one of the most difficult things I think most investors have to get to understand is that the reality is the central banks are trying to slow things down. They've done a really good job with it. Inflation was 8.3%. We're kind of in that 3.5% to 4% zone now. That's been a real success. We have the difficult things now.
Yeah.
They're going to continue the pressure on until we get there.
I've only got about 2 minutes here, Brad, but I do want to ask you just, in terms of deterioration, one thing we've noticed, of course, is, China and what's happening with China and the decoupling that's happening. And it's almost like there's an economic decoupling, there's a political decoupling. It's just right across the board and the impact that could have. That kind of builds, I think, into your thesis as well.
Right, yeah, look, that over the last, I'd call it the last 18 months, pretty consistently in our portfolio strategy quarterlies, we've been working on this theme of that this is a really, really significant, if not monumental shift we're in the middle of right now. I mean, like the kind of stuff you see every few decades.
Yeah.
And that if we went back on what does that mean in economic terms and investment terms, is that when we started in January 1st, a lot of folks were saying, okay, the pandemic in China is over, they're going to open back up again, and we're going to see 5 and 6% growth. Well, we're seeing about 2% growth there, and when you look at our TD economics and look at ourselves where we're looking out, we're talking a couple hundred basis points growth down the road. And reason for that is they've got an awful lot of headwinds there. And so that we need to, if anything, I think the best thing to learn from China right now is that we need to start adjusting our thinking, the way we look at things, and that I think there's a lot of investment clients out there have portfolios built for an environment that actually doesn't exist any longer. And I think it's, and making those changes and looking down and saying like, what is my investment aspirations over the next 5 years? Building a plan up against that based on the new reality in the world that we live in, which presents a lot of investment opportunities, right? But you got to change the way you look at things. As we always say with risk priority management, you need to adapt and think about it in that way.